welcome to another episode of Fast Five. I'm your host, Brent, and I want to share with you 5 quick market ideas in less than 5 minutes. Getting started, you probably heard last Friday, the jobs number was reported by the government and came in much less than expected, only 30,000 less than expected for only 73,000 jobs traded in the month of July. But importantly, there were 2 significant revisions to the data in the previous 2 months, which is normal, but it really irked President Trump, who fired the head of the BLS, which is uncommon. So I have a graph here from the Wall Street Journal over the weekend, and it's showing you there has been a consistent downtrend in the number of jobs created monthly, but the unemployment rate remains relatively strong, 4.2%. Moving on, I think one of the most important indicators in the market right now are inflation rates. And so the government reported the data for June, and they'll report July's next week. But in June, the data was reported at 2.7%. The Federal Reserve's benchmark is 2%, so you can see it's significantly above that. And that's preventing the government from lowering interest rates, which is what the president wants. But I have up here some data that I think is better. It's from a private company called Truthflation, and they actually measured 15 million data points in real time and give you, I think, a better indication of what inflation actually is looking like. And you can see they're reporting right now at 1.75%. That could suggest that inflation is going to be coming in lower than what we're expecting with all the tariff data and what the government's suggesting, which could mean the government has the opportunity to lower interest rates sooner than later. So idea number 3 is rates. We should be expecting an interest rate cut from the government of 0.25% in the month of September. That's their next meeting. So I have a chart up here from CNBC that's showing you the 10-year Treasury rate has actually been declining significantly. Since early part of this year, that rate was around 4.7%, and as of yesterday, 4.2%. That's a pretty seismic shift in that 10-year Treasury number. And also, just a quick data point for Polymarket. You may have heard of them, but they're a betting website. You can bet on anything, including election outcomes and including what the Federal Reserve is going to do if you're that type of person. But at the moment, there's an 80% chance, according to Polymarket, that markets are expecting a 25 or 50 basis point cut at the September meeting. So keep an eye out for that. September, we'll probably have that going forward. I want to share point number 4, just a few pessimistic ideas, things to be aware of as we go into late summer. These are both from Barron's over the weekend. The first is the Citibank Panic Euphoria Index. It's one of my favorite indicators, but you can see here that that's the chart on the left, but that black line is clearly in the high part of the blue area. That's what's called the Euphoria Index, meaning that people are very optimistic, typically a contrarian indicator, typically a bad sign for the next 12 months. Not always, of course, but something that I'm aware of has got my ear to the ground. And then on the chart on the right there, this is just the equity put-call ratio. It's measuring the number of puts, which are people seeking protection, versus calls, people seeking leverage bets on the marketplace. And so that green line is coming down to a kind of a trough, kind of a bottom, and it's just meaning that fewer people are looking for protection, which means there's kind of complacency in the market. It could be a constrained indicator, something that I'm definitely watching. But the major point I want to make here, this is a chart from JP Morgan, that's showing you the price to earnings ratio of the S&P 500 index. And you can see here that it's well over 1 standard deviation above normal. Current price to earnings ratio trading at about 22, and then the 30-year average is about 17. What this means is that we're paying more for the earnings of the companies in the S&P 500, which is typically a bad thing. It means markets are frothy or markets are expensive. And it also means that markets could have a lower, next 10-year return than they had over the previous 10. So something to be aware of. Might be a good opportunity to invite alternative investments into your allocation. And then finally, point number 5, I want to end on some optimistic notes here because it is summertime. The first year is from our friends at Carson Wealth, and the market actually had a really great momentum moment. It was up over 60 days in a row above its 20-day moving average, just a measure of the momentum in the market. But it's still a good sign. It's happened only 7 times in the last 50 years, and 7 of those last 8 times were positive, and 5 of the last 5 since that last data point goes back all the way to 1971. So 5 of the last 5 times this has happened, markets are positive, and it looks really good for the next 6 and 12 months. So this momentum could continue to build over time, and that's typically a good indicator of that. So I think it's something to be aware of, that 12-month figure for the last 5 occurrences, well over 15%. So it could be above average return over that period of time. And the last thing I want to just end on an optimistic note, earnings have come in very good. Why are stocks doing well? Well, they're measured on earnings, and corporate companies are making a ton of money. So you can see there's been a 10.1% year-over-year growth after 82% of companies have reported. This is great. This is what bullish markets. We want strong earnings from companies, and that's certainly what we're getting here. And despite what we've heard in the tariff concerns and on the news, things have worked out really well. So just 5 data points there for you. I'll see you again in a couple weeks.